Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host Chris Seveny. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveny, and today I am going to talk about the recent report by the New York Fed that came out, along with some information from Consumer Credit Panel and Equifax. And for those, also have a video attached to this as well. And I want to talk about the report and what that means for those investing and in the note investing space or in the real estate. So the first chart I'm going to dive right into is an overall total balance of delinquencies within the U.S. markets. Now, this does include more than mortgage, includes credit card, car loans, everything. And when we look at this chart, let's now take out for 2007 to 2013, essentially, which was the Great Recession. I am a believer that we will not have a recession equivalent to that. I think there were a lot of safeguards put in place, hopefully protect us from that type of downturn. But that doesn't mean that there's the potential for a recession. If we look at where things are today in the economy, from a jobs perspective, from an affordability perspective, I am a believer that I think things are probably going to get a little more challenging over the next few years before they get better. I do have to use a caveat that I'm not an investment advisor. I'm not providing financial advice. I'm just a dude providing my opinion. And when we look at the total balance by delinquency status, this does go back 20 years. When we look at where we are at today compared to historical, we'll see that, severely delinquent, which is the dark red on this, is floating around about 1%, and overall delinquencies is floating a little bit above 3%. If we were to average out where that number is typically at, we are probably about 30 or 40% below the norms. So overall delinquencies compared to historical is below what the median has been over the last 20 years. So then the question, of course, is, are we going to stay below the median, or do we think that we will head back up towards that norm? Just wanted to share this first chart as kind of the intro to where things are overall. Now, if we head to the percent of balances of loans that are 90 days past delinquent. First thing I'll make note of this is student loan debt has been paused. So you'll see that has gone from over 10% defaults down to 0, which that's going to be interesting to see how that does play out, because if that does kick back in, there's a lot of people with a lot of student loan debt. And when you factor in the cost of housing, the cost of rent, where salaries have been, I'm a believer that salaries have not kept up with what it costs to live and for housing and where inflation is at. And granted, I hear reports of inflation is down 2 to 3%, but man, I go to a grocery store, I go shopping, it seems like stuff is still really expensive and getting more expensive. So only look at the data that's being provided. But what is interesting on this is you'll see credit card debt is up to about 11% of 90 days past due. Over the last 10 years, that average has probably been about 7%. So credit card debt is spiked to essentially getting the equivalent of where we're at in 2008. So for me, that would be some cause for concern. Auto loans, which are on this, are pretty much have always been in line with a little bit below 5%. That's been pretty much consistent. The mortgage balances, that has, historically been 2 to 3%, and right now that is still at all-time lows. Now, what is going to be interesting and this is where I'm going to put on my mortgage note investing hat, is during COVID, we had such a huge ramp up and increase of property values and easy money. There were a lot of people refinancing and getting revolving lines of credit. We've seen loans that where people were getting those lines of credit, maxing them out to pay off their credit cards, only to a year later be in that credit card default. So question posed on this chart is mortgage debt and defaults going to stay at historical lows, or is that going to come back up to the norm? With everything else, if you look at this chart, starting to rise, and again, credit card is probably the scariest where that's going, especially with rates probably in the 20% plus. Definitely something to watch for, something to consider. Thankfully, people with their homes have equity that they can use to sell their homes, but that still doesn't mean that they might not go into default. So curious for those listening, what are your thoughts? So as we move on into the next chart, and this is an interesting chart as well. It's a transition into delinquency, meaning what percentage of loans are starting to move from being current into being delinquent. And let's take out student loans from this chart because it's essentially zero. But what we're starting to see is every type of loan is starting to increase, but it's also starting to increase pretty rapidly. Credit card debt 2022, probably around 4%, up to 9%. Auto loans was around 5%, that's up to 8%. And mortgages were under 2%, and that's floating up to over 3.5%. So we're starting to see, that increase in defaults. So what does that mean? To me, I think a lot of people are still very bullish on real estate, thinking that if interest rates go down, prices will start to increase in the economy doing well, and real estate goes up forever. Unfortunately, that's really not the case. Real estate is not linear. No market is linear, meaning it just consistently increases over a period of time. It goes up, it goes down, it goes back to a norm historically. And, the markets have been hot, starting to see, potentially some ups and downs there in real estate. I read a report in Jacksonville how Jacksonville is having a significant increase of houses on the market, and an investor there is getting very nervous. So as we look into this transition into the delinquency, the mortgage numbers have typically been around, again, taking out 2007 to 12, around 5%. We're a little bit over 3.5%. We get back to norm. What does that mean for note investors? Right now, we continue to see product, not a ton of product, but we're starting to see a little bit more coming on the market. I think based off of this data, we're going to continue more loans market. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at 7E, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly, with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@70investments.com to learn more. Thank you. As we move into the next slide, which the last slide was transition into serious delinquencies of 30 plus days. Now we're going to talk about loans that are 90 plus days. And for people listening on the podcast, again, we'll have all these charts online to download and watch. So as we look at the transition to 90, we have the student loans, again, throw those out. And interestingly enough, on this chart, it doesn't show as a significant uptick as we did on the 30-day. Credit cards, again, credit card delinquency rates are just really starting to skyrocket and really start to move. Also starting to see it on auto loans, which is probably not unexpected because cars were selling for extremely significant amount of money and at high interest, and people with those payments are realizing they can't afford it. And for me, when I put on my thinking cap, I look at real estate usually takes a lot longer than others because of its illiquidity, start showing signs. But if you look at auto loans and look at kind of what's happening there, cars were overpriced. People probably have a little regret in buying. And people probably over leveraged. Now they're starting to run into a little bit more trouble. They're probably now back at the average or a little above where that average is. I'm suspecting in the next 24 months, we're probably going to see similar data on the mortgage side of space as well, that we're going to start to see people get into more delinquencies on these loans. So as we look at another chart of transition rates for current mortgage accounts, and this is, again, just mortgages that go from 30 to 60 days late and those that go to 90 days late. This actually surprised me a little bit. The 30 to 60, again, pretty much at all-time lows, was at all-time lows during COVID, continues to remain there at 0.8%, 0.8%, 8%. Historically, you're probably at about 1.25. So still, when you look at that numbers, almost 50% below the historic norm, even though they're small numbers. But to the 90-day late, the transition rate is pretty much always been very consistent over the last 20 years. Besides, again, the great financial crisis, this looks like kind of one of the little heart monitors that has very little flubs to it. So I did find that interesting to see where that is. And me, honestly, not a lot of data pull from this. But again, the expectation of, I think those 30 to 60 day numbers where people are starting to get behind is going to continue to increase. So next one I thought was also interesting, which we talk about now, the quarterly transition rates for 30 to 60 days late on mortgage accounts. Loans that are behind that go current are actually doing very well. So people are catching back up. Historically, that number is probably around 35 to 40%. And today we're at about 50% of the loans that are delinquent are transitioning back to being current. Now, question is that I pose to people, are they getting back to current because they're making the payment, or are they getting back to current because the servicer is pushing those payments on the back end and bringing the loan current? That's the interesting part of this statistic. And you notice in 2020, you saw that number jump to 60%, and it starts to spike a little bit down more and more. I believe a lot of it is because loans are being brought current, not people actually making that payment. So this is an interesting thing to watch as we continue to move forward. How are the banks reacting to these loans, especially these lower interest loans that go behind and get current? Because it'll be interesting how they look at it on their books. And if there's a continuation of borrowers constantly getting behind and an economy where unemployment's near all-time lows and could increase, the bank's going to continue to work with the borrowers, or they're going to push them into the 90 plus days late, which is floating a little bit above 10% right now. Historically, probably around 15%. So again, those transition rates did shoot up after COVID, but be interesting to see, where this transition is. But not only looking at the data, but why are these numbers the way they are? And is it because of people coming up with those payments again, or is it individuals having their loans deferred? And then the last chart is number of consumers with new foreclosures and bankruptcies. And this one I want to spend a few minutes with and talk about, because this is probably, for investors, one of the most relevant talking points. There's a lot of people who are interested in note investing and want to get into the space. And when they think of non-performing, some people want to get into space to foreclose, take the property, get it at a discount, fix it up, rent it, sell or finance it, whatever your preference is. If I were to guess, and I'm just pulling a number out of my head, the last 10 loans that we were trying to work something out with the borrower but were unsuccessful, I don't believe one of them foreclosed. It's owner occupied. Every single one went into bankruptcy. And we're seeing a significant increase in bankruptcies over foreclosures, which you can see on this chart, where bankruptcies were always significantly higher than the number of foreclosures. 2020 to 2022, huge spread, but it's always been about twice as many bankruptcies as foreclosures, if I were to guess, looking on this chart, except for 2008 to 12, where people were okay with the foreclosure because they're so underwater and did not want to keep their house. But what this again shows, and when we look at our business model, is we want to try and work things out with the borrower because they want to stay in their home. And people wouldn't be filing bankruptcy if they didn't want to stay in their home versus the foreclosure. Now, we've seen over the last 3 years this number be pretty consistent between foreclosures and bankruptcies for those looking at the chart. But again, we go back and look at these historic norms. We were probably from 2014 to 18 average 275,000 bankruptcies and 100,000 foreclosures, and we're at half those numbers today. So let that sink in for a second. As note investors, I know a lot of times people, again, talk about the lack of inventory, lack of defaults. Do we think that the norm from where we were in 2018, 19, and 20, which then dropped down significantly because of government intervention, now that government intervention isn't around, is going to stay at all-time lows? Or do we think it's going to revert back to the mean? If you're asking me, I think we're going to revert back to the mean. If we revert back to the mean, that means we will see a significant increase in defaults, borrowers filing bankruptcy, and more foreclosure filings, which gives people more opportunity within the note investing space. So I wanted to share this information with people. If people are interested in more information or the full report, feel free to reach out to us. We will happily share that, email it with you. It is the New York Fed Consumer Credit Panel report. So it's something that is easily downloadable. This is all information that is publicly available. So hope you enjoyed this episode of Creating Wealth Simplified. And as always, make sure to leave us a review, make sure to follow us. And if you're interested in more information about our offering or learning more about notes, please feel free to reach out to us. Thank you all. Have a wonderful day. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.